Welcome. Today we are going to be talking about managing your margin and capital in the market. In this video, I'm going to break down margin and capital management in the simplest way possible. No complicated terms, no confusion, because once you understand this, you'll stop trading like a beginner and start thinking like a professional. Let's start with margin. Margin is not money you're risking. Margin is the amount of money your broker sets aside so you can open a trade. Think of it like a deposit. For example, if your broker gives you leverage, you don't need the full amount to open a trade. You only need a small portion. That's your margin. Now let's talk about leverage, because margin and leverage work together. Leverage allows you to control bigger positions. With a smaller account, for example, with 1 to 100 leverage, you can control $10,000 with just $100. Sounds powerful, right? But here's the problem. Most traders abuse leverage, and that's why they lose money. Here's where people go wrong. They open positions that are too big for their account size, so even a small move against them wipes out their account. This is called poor capital management. Not a bad strategy, not bad luck, just bad risk control. Capital management is how you protect your money. It's how much you risk per trade, how you size your positions, and how long you survive in the market, because trading is not about one trade. It's about staying in the game long enough to win consistently. Here's a simple rule professionals follow. Risk only 1%, or at most 2% per trade. That means, if you have a $100 account, you should only risk $1 to $2 per trade, not $10, not $20, because one bad trade should never destroy you. Most beginners think small risk means small profit, but that's short-term thinking. Let's be real. If you risk 10% per trade, it only takes a few losses to blow your account, but if you risk 1%, you can survive losses, learn from mistakes, and grow your account over time. Consistency beats aggression every time. Now let's talk about margin calls. A margin call happens when your account can no longer support your open trades. This usually happens when you over-leverage, you risk too much, you don't use stop losses, and when that happens, your broker starts closing your trades automatically. That's how accounts get wiped out fast. So here's the truth. You don't need a better strategy. You need better control. Understand margin, respect your capital, and manage your risk, because in trading, the goal is not to get rich quick, it's to stay profitable long term. Protect your account, and your account will grow. And as always, be sure to like, share, and subscribe for more. Thank you for watching.